Hey everyone, trying to pick that one breakout stock. It's tough, right? It's like looking for a needle in a giant haystack. But what if there was a way to just buy the whole haystack? That's what we're talking about today, a really powerful tool for long-term investing called an exchange-traded fund, or ETF. How can you invest in an entire idea instead of just one single company? Well, let's dive in and find out.
Okay, but before we get started, we've got to get the important stuff out of the way. Just a quick heads up. This explainer is purely for educational purposes. Nothing we talk about today should be taken as financial advice. We're here to break down the concepts from our source material, not to tell you what you should or shouldn't buy or sell. All right, let's go.
So let's say you're really interested in the market. Maybe you think the future is all about tech, or you see the long-term stability in healthcare. But trying to pick the one winner, the next Apple or the next NVIDIA, that feels like a massive gamble, doesn't it? So is there a simpler way? What if you could invest in a whole sector, a whole trend, all at once?
And that is exactly where ETFs come into the picture. The easiest way to think about an ETF is like a basket. So instead of going to the store and trying to pick the single best apple, you're buying a pre-made basket that already has all the top fruits inside. It's one single investment that holds a whole collection of different stocks, giving you that broad exposure with just one single purchase. Pretty cool, right? All right, so here's what we've got on tap today. We're going to start with SPY, which is kind of the benchmark for everything. Then we'll spotlight some specific sector ETFs. After that, we'll explore some that are focused on the future. We'll also talk about a strategy that's all about patience. And finally, we'll wrap it all up with the key takeaways. Sound good?
Okay, let's kick things off with Section 1, SPY, the market benchmark. You really can't understand ETFs without starting with this one. It's the big one, the fund that basically tracks the pulse of the entire U.S. stock market.
Our source material has this perfect way of putting it. They call SPY the godfather of the ETFs. And that's exactly what it is. It's the original, the benchmark, the standard that everyone uses to measure how the market is doing overall.
So what's actually in this Godfather basket? Well, SPY tracks the S&P 500. And that's just a fancy name for an index of the 500 biggest companies in the US. We're talking about the absolute giants here. Microsoft, Apple, NVIDIA, you name it. And what's really important to know is that the fund is weighted by company size. So whatever these big players do, that has a huge impact on how SPY performs.
Now, here's something that's super useful. Watching SPY gives us a really clear way to talk about the market's health. You'll hear the term correction thrown around a lot. Well, that just means SPY has dropped 10% from a recent high. But if it falls 20% or more, that's what Wall Street calls a bear market. So by just keeping an eye on SPY, you're getting a quick snapshot of the market's mood. Is it just a little nervous, or is it in a serious downturn?
All right, so tracking the whole market with SPY is one approach. But what if you have a strong feeling about a specific industry? Maybe you're really bullish on tech, or you think healthcare is the place to be. Well, that's where sector ETFs come in. Let's start with semiconductors. The tiny little chips that power literally everything these days, from our phones to all this new AI stuff. The main ETF for this sector is SMH. That's its ticker symbol, just the unique code you use to find it on an exchange. Inside SMH, you'll find the key players like NVIDIA and TSM. It basically gives you a direct investment in what our source calls the future of technology.
Now, one thing to know is that a single share of SMH can be a bit on the pricey side. So for anyone looking for a more accessible way in, our source points to an alternative called SOXQ. The interesting thing is it tracks the exact same semiconductor companies. So if you look at their charts, they move almost identically. SOXQ is just at a lower price per share. Okay, let's switch gears to another huge sector, healthcare. The ETF to know here is XLV, and the logic behind it is pretty straightforward. No matter what's going on with the economy, people always need healthcare, right? That's what makes it a historically stable long-term sector to keep an eye on. And when you peek inside the XLV basket, you can see why it's considered so solid. It's not just one thing. You've got the giant pharmaceutical companies like Eli Lilly and Johnson & Johnson, but you've also got major health insurers like United Health. It's a really diversified bet on the entire healthcare system. So what about big tech? You've probably heard of QQQ, which tracks the 100 biggest non-financial companies on the NASDAQ. But our source also brings up TQQQ. And listen up, because this one is very different. TQQQ is what's called a leveraged ETF. That means it's designed to give you 3 times the daily performance of the NASDAQ 100.
Now that might sound amazing for gains, but it also means it brings 3 times the losses. It's incredibly risky and is generally a tool for short-term traders, not something for a long-term set-it-and-forget-it strategy.
Okay, let's look even further down the road now. Beyond the big, established sectors, there are also ETFs built to try and capture technologies that could, completely change the world.
First up is AIQ. And as the name suggests, this one is all about artificial intelligence. With AI becoming a part of pretty much everything we do, this fund tries to group together the companies that are leading that revolution. It's a way for investors to get exposure to that potential growth.
And then there's QTM. This one focuses on quantum computing. Now, this is really, really important to hear. The source gives a strong warning on this one. It is highly speculative. The companies inside this ETF are not profitable yet, and based on the research mentioned in our source material, they might not be for at least another 3 years. So this is a bet on a very, very distant future.
So, we've talked about a bunch of different ETFs, which covers the what to invest in. But our source material makes a huge point that when you invest is just as critical. And this brings us to the core strategy here: patience.
This number, this is the whole game right here. The strategy we're breaking down isn't about buying when everything is exciting and prices are at all-time highs. Nope. It's about being patient and waiting for a significant market drop, a bear market of 20%, maybe even as much as 40%, before even thinking about getting in.
And this quote from the source really just says it all. I'm going to be patient and wait on these to drop from all-time highs. It's a really disciplined way of thinking that's all about waiting for the opportunity to come to you rather than chasing the market when it's running hot.
So let's boil it all down into 3 simple steps. Step 1, you identify the sectors or the big ideas that you believe in for the long run. Step 2, you wait. You wait patiently for a major market downturn. And step 3, the plan is to hold for the long term. We're talking 5, maybe 10 years, to give things time to potentially recover and grow. All right. That was a lot of information, I know. So let's take a second to just recap the key takeaways from this whole explainer. So here's the quick cheat sheet. You've got SPY, that's your godfather, the benchmark for the whole market. SMH is your bet on semiconductors, the future of tech. XLV offers that long-term stability through healthcare. TQQQ is that high-risk leverage play on big tech. And then you have AIQ and QTUM, which are those forward-looking bets on AI and quantum computing, with QTUM being the most speculative of the bunch.
So we've seen how ETFs can be a simpler way to invest in big market trends, and we've walked through a strategy that's all about patience. But it leaves us with one final question to think about. Understanding sectors is one philosophy, for sure, but what other kinds of ideas might shape a really solid long-term plan? Something to think about. Thanks so much for tuning in.